Every dollar you earn asks you one question: will you spend me or will you multiply me? Most people answer without thinking. They buy things that lose value the moment they leave the store, then wonder why their income never turns into wealth. The wealthy don't make better money, they make better purchases. Before they buy luxury, they quietly buy assets that produce more money. That's the difference between looking rich today and becoming rich for decades. Your salary is important, but it has one weakness. It depends on you showing up. Wealth begins when money starts arriving whether you're working or not. That's why your first goal isn't a bigger paycheck, it's building cash flow. Every asset that pays you repeatedly buys back your future time. The sooner you own cash-producing assets, the sooner work becomes optional instead of mandatory. Most people upgrade their phones every 2 years, but never upgrade the skills that determine their income. The market doesn't pay you for effort, it pays you for value. A valuable skill increases every future paycheck. That extra income becomes investment capital, and investment capital becomes long-term wealth. One skill can create millions over a lifetime. The average person buys products. Wealthy people buy pieces of the companies that sell those products. Every purchase can either make someone else richer or make you a shareholder. Owning businesses through diversified investments means thousands of people work every day to increase your wealth. That's leverage most people never understand. Most people wait until they have enough money to invest. That's backwards. Time creates wealth faster than large investments ever will, because compound growth rewards years, not ego. Small amounts invested consistently outperform large amounts invested too late. The richest investors aren't always the smartest. They simply gave compounding more time to work. The average person thinks investing is about picking the perfect stock. Professional investors know that's a distraction. The real engine of wealth is owning productive assets for long enough that your returns begin earning returns. In the beginning, your money works for you. Eventually, your profits work harder than your salary ever could. Most people quit investing because the first few years feel slow. That's exactly when the biggest mistake happens. Compounding is backloaded. The majority of your wealth is often created in the final years, not because you invested more, but because you stayed invested while everyone else kept starting over. The average investor asks, "How much money can I make?" Smart investors ask a different question: how much money can I lose? That's the principle called the margin of safety. Wealth isn't built by chasing the highest returns, it's built by avoiding permanent losses. Every dollar you don't lose has decades to compound into far more wealth than a risky investment ever promised. The greatest investors don't try to predict tomorrow's market, they prepare for it. They diversify across productive assets, keep cash available for opportunities, and never risk money they can't afford to leave invested. The first rule of building wealth isn't maximizing returns, it's staying in the game long enough for compounding to do its work. Banks earn billions from one financial law that most people never truly understand. Compound interest doesn't care whose side it's on. When you invest, compounding builds your wealth. When you borrow for depreciating assets, the exact same force builds the bank's wealth instead. The question isn't whether compounding works, it's who it's working for. The middle class often focuses on income, while wealthy investors focus on net worth. Income pays today's bills. Net worth determines tomorrow's freedom. Every month, ask yourself one question: did my assets grow faster than my liabilities? That's the scoreboard serious investors watch. Once your assets consistently outgrow your debts, wealth becomes a mathematical outcome, not a matter of luck. The biggest financial mistake isn't earning too little, it's measuring the wrong number. Most people celebrate a salary increase while ignoring their savings rate. If your income doubles but your lifestyle doubles with it, your wealth doesn't grow. Investors understand that the gap between what you earn and what you spend is the fuel that buys assets. A person earning $60,000 and investing 30% every year will often outperform someone earning $150,000 who invests almost nothing. Income creates opportunity. Savings rate determines how much of that opportunity becomes wealth. Here's how financially free people think. Every paycheck is divided before it's spent. First comes investing. Second comes saving. Only then comes spending. They automate contributions into broad market index funds, retirement accounts, and other productive assets before lifestyle has a chance to consume the money. The goal isn't to look wealthier every month, it's to own more income-producing assets every year. That's why their net worth accelerates while everyone else keeps restarting from zero. The biggest myth in investing is that you need to find the next Apple, Amazon, or Nvidia to become wealthy. The data tells a different story. Over long periods, most professional fund managers fail to consistently beat broad market index funds after fees. That's because markets reward diversification, patience, and low costs, not constant buying and selling. Instead of trying to predict tomorrow's winner, own a small piece of hundreds of great companies and let the global economy work for you. The wealthiest long-term investors understand one principle: time in the market beats timing the market. They invest consistently through bull markets, bear markets, recessions, and recoveries because they know volatility is temporary but ownership is permanent. Every market crash has eventually been followed by recovery, rewarding disciplined investors who kept buying while everyone else was selling. The goal isn't to predict the next market move, it's to keep accumulating productive assets for decades until compounding becomes unstoppable. Most people invest by following headlines. Professional investors invest by following financial statements. Before buying a stock, they ask 3 questions. Is revenue growing? Is profit growing? Is free cash flow growing? A company can report billions in sales, but if expenses rise faster than revenue, shareholders don't become wealthier. Revenue creates attention. Free cash flow creates value. That's why the best investors spend more time reading annual reports than watching financial news. The greatest businesses don't just make profits, they generate consistent free cash flow, maintain high returns on invested capital, ROIC, carry manageable debt, and increase earnings per share year after year. Those are the characteristics that allow companies to survive recessions, reward shareholders, and compound wealth over decades. The stock price may fluctuate daily, but the long-term value of a business is ultimately driven by the cash it generates and the efficiency with which management allocates that capital. Steve Jobs didn't become wealthy because he collected a salary. Elon Musk didn't build billions by saving paychecks. Mark Zuckerberg didn't create generational wealth by timing the market. Their wealth came from ownership. They owned meaningful stakes in businesses that created value at scale. That's the lesson every investor should understand. Salaries create income, but equity creates extraordinary wealth. Even if you never build a company, you can still become an owner by consistently investing in businesses through broad market index funds, ETFs, or carefully selected individual companies. The formula for building wealth has never changed. Earn more, spend less than you earn, eliminate high-interest debt, invest consistently in productive assets, reinvest your returns, and stay invested for decades. Ignore the daily headlines, ignore the market noise, focus on increasing your net worth every year. The people who achieve financial freedom aren't usually the smartest, they're the ones who stay disciplined the longest. Your next dollar is a decision. Consume it today or invest it to buy a future you don't have to work for. Every financial decision you make fits into one of 2 categories. It either buys an asset or buys a liability. Assets pay you, liabilities cost you. If you consistently increase the number of assets you own while keeping liabilities under control, your net worth will eventually grow beyond the income from your job. That's the moment work becomes optional and financial freedom becomes a mathematical certainty rather than a dream. Remember this, your paycheck can make you comfortable, but your assets can make you free. Build valuable skills, protect your cash flow, eliminate expensive debt, invest consistently, reinvest every return, give compounding decades to work. Do that long enough, and one day your investments will generate more income than your salary ever could. That's when you've truly gone from broke to built.